What's up guys and welcome to Wall Street Millennial. Today on February 18th, Keith Gill, aka Roaring Kitty, will testify before Congress regarding the GameStop saga. Before the hearing started, Keith released his opening statement defending himself from accusations of market manipulation. In this video, we're going to go over his testimony and what it could mean for the hearing going forward. He starts off by saying, "Before I go further, I want to be clear about what I am not. I am not a hedge fund. I do not have clients and I do not provide personalized investment advice for fees or commissions. I am an individual investor. My investment in GameStop and my posts on social media were entirely my own. I did not solicit anyone to buy or sell the stock for my own profit. I did not belong to any groups trying to create movements in the stock price. I never had a financial relationship with any hedge fund. I had no information about GameStop except what was public. I did not know any people inside the company and I never spoke to any insider. As an individual investor, I use publicly available information to study the market and the value of specific companies. I consider a complex array of factors and track hundreds of stocks, all in search of market inefficiencies. Like many people, sometimes I post on social media my thoughts and analysis about individual stocks and whether they are correctly valued." So he starts off by saying that he's an individual investor and had no conflicts of interest. He didn't advise any clients and wasn't involved with any hedge fund. He posted his opinions about individual stocks on social media and YouTube, which is a common practice among investors and is completely legal. He goes on to say, "I did that with GameStop. I believe that the company was dramatically undervalued by the market. The prevailing analysis about GameStop's impending doom was simply wrong." So he had a differing opinion about GameStop. Most market participants and so-called sophisticated institutional money managers thought GameStop was a failing mall-based retailer which was doomed to fail. GameStop's business was under pressure as they lost market share to e-commerce giants like Amazon and digital game platforms like Steam. Hedge funds thought that GameStop's business model was unviable in the new age and aggressively started shorting the stock. It became one of the most popular stocks to short, with short interest continually rising. The heavy shorting drove the stock down more than 95% from its highs of $56 in 2013. But Keith's analysis of GameStop led him to a different conclusion. While GameStop was indeed facing challenges in its legacy business, Keith saw an opportunity for the business to turn around. GameStop had a rapidly growing e-commerce business in GameStop.com, which actually grew 800% in the most recent quarter. In addition, they are making new concept stores in Tulsa, Oklahoma that will serve as community centers for gamers, something that can't be replicated online. They are also shifting their efforts within their stores to focus more on collectible items, something that can't be sold through Steam. Keith saw these efforts and thought the market wasn't giving GameStop credit for any of these new initiatives, as shares were trading in the low single digits in mid-2020. Keith saw this as a mispricing and was incredibly bullish on the stock given its cheap valuation. He goes on to talk about his background. "A little about my background. I grew up in Brockton, Massachusetts. My father was a truck driver and my mom a registered nurse. I was one of 3 kids and the first in my family to earn a 4-year college degree when I graduated from Stonehill College in 2009, amid the Great Recession and without a long-term job. My first post-college job was in operations at WB Mason, an office supplies company headquartered in my hometown of Brockton. Between 2010 and 2014, I worked for a family friend at a startup company in New Hampshire, trying to build a software program that would help investors analyze stocks and offer related research. We also tried to start an investment firm which dissolved not long after it was created. My salary never exceeded $40,000, but I did learn something about investing. I learned how to do the tedious work of digging through a company's financials and focusing on its real long-term value, not prevailing market sentiment or headlines. I married my wife Caroline in 2016, and I found a job working operations and compliance at LexShares. I left that job in March of 2017, and for the next 2 years I was effectively without a job. During that time, I began actively analyzing a wide array of stocks to try to keep and increase our limited savings. It was both a way to make money and an interest that I pursued passionately while I lacked a job." So he explains how he grew up to working-class parents in a small city in Massachusetts and was the first in his family to go to college. He was an average working-class guy, switching from job to job while learning to invest his own money as an individual investor. He built up his skills in how to analyze financial statements and understand the fundamentals of publicly traded companies. His hard work and prudent investing eventually led him to making extremely successful investments into GameStop, which made him tens of millions of dollars in profits. This is a truly heartwarming rags-to-riches story and exemplifies the American dream of economic mobility. He goes on to say, "In April 2019, I accepted a marketing and financial education job at MassMutual. Caroline and I were both happy about our prospects. I had never made a salary over $100,000 a year before, and I was thrilled just to be working and to have benefits again. My title was Director, Financial Wellness Education. My job was to help develop financial education classes that advisors could present to prospective clients. I never sold securities, and I was not a financial advisor. He did work at MassMutual, where he helped making financial education classes. He was never a securities dealer or financial advisor, so there were absolutely no conflicts of interest with his own personal investing or social media activities. He explains his position in GameStop in more detail. I continued analyzing stocks on my own time and investing my family's funds. In early June of 2019, the price of GameStop stock declined on worse than expected earnings, and it began trading at a deep discount, below what I thought was its fair value. I was aware from public reports that a well-known investor, Michael Burry, was interested in GameStop. Because I thought that the stock was undervalued, I purchased call options on June 7, 2019. I increased my position throughout much of 2019 and 2020, because as I continued to analyze the company and its prospects, I became increasingly confident that the share price was indeed dramatically undervalued. Two important factors, based entirely on publicly available information, gave me and many others confidence that GameStop was undervalued in 2019 and 2020. First, the market was underestimating the prospects of GameStop's legacy business and overestimating the likelihood of its going bankrupt. GameStop, the only major retailer dedicated to gaming, has over 60 million members in its loyalty program and continues to maintain a sizable market share within the gaming industry. Its legacy business, comprised primarily of selling physical video games and related equipment within their stores, was likely to generate meaningful cash flow following the release of new gaming consoles in late 2020. I grew up playing video games and shopping at GameStop, and I'm looking forward to buying a new console at GameStop. I knew the company had an opportunity to reinvigorate this business by improving customer service for gamers, upgrading its online presence, and offering complementary product lines such as PC gaming and accessories. Second, I believed, and continue to believe, that GameStop has the potential to reinvent itself as the ultimate destination for gamers within the thriving $200 billion gaming industry. The new console cycle provides GameStop a unique opportunity to pivot from a traditionally brick-and-mortar mindset towards a technology-driven business that excels in gaming products, experiences, and services. By embracing the digital economy, GameStop can pursue new revenue streams, including larger gaming catalogs, digital content and community experiences, online trade-ins, streaming services, and esports. While I may be the only panelist here today who had faith in GameStop, I was hardly the only person who advocated these points or ones like them. Investors including Chewy co-founder Ryan Cohen, whose purchase of GameStop shares and advocacy within the GameStop board helped positively affect the share price in late 2020, publicly expressed similar views. He explains that while GameStop shares were tanking, his conviction in the stock price increased as he believed they actually had a chance of turning around the business. And he wasn't the only one with this view. Famous investor Michael Burry, who successfully called the subprime mortgage crisis in 2008, as well as Ryan Cohen, the billionaire founder of Chewy, both shared Keith's view that shares were severely undervalued. As Keith's conviction in the stock grew, he increased his position, which is a completely normal and rational thing to do. He then addresses why he posted about his GameStop position on social media. I want to pause to note that the investment I made was risky, but I was confident in my analysis and I was willing to accept the loss if I was proven wrong. My timing was far from perfect, and many of the option contracts I purchased expired worthless because GameStop's stock price remained depressed longer than I expected. I've been asked why I decided to share my investment ideas on social media. My investment skills had reached a level where I felt sharing them publicly could help others. I also thought that by sharing my own ideas and accepting critiques, I could be able to identify holes in my analysis. Hedge funds and other Wall Street firms have teams of analysts working together to compile research and critique investment ideas, while individual investors have not had that advantage. Social media platforms like YouTube, Twitter, and Wall Street Bets on Reddit are leveling the playing field. And in a year of quarantines and COVID, engaging with other investors on social media was a safe way to socialize. We had fun. He wanted to help other individual investors trade intelligently. Over the years, he has built up incredible investing acumen and shares a lot of good information on his YouTube channel, not just about GameStop, but about how to invest as an individual in general. While hedge funds and other institutional investors have teams of people and access to expensive and proprietary research, individual investors are at a disadvantage trying to figure out everything on their own. The rise of social media and forums such as Wall Street Bets have helped to close this gap and give individual investors an opportunity to learn from each other, and Keith wanted to play a constructive part in this. He then defends himself from the absurd claims that he was involved in market manipulation. The idea that I used social media to promote GameStop stock to unwitting investors is preposterous. I was abundantly clear that my channel was for educational purposes only, and that my aggressive style of investing was unlikely to be suitable for most folks checking out my channel. Whether other individual investors bought the stock was irrelevant to my thesis. My focus was on the fundamentals of the business. It's worth noting that after 5 months of continuous streaming, my final stream of 2020 topped out at just 96 concurrent viewers, with an average view duration of just 25 minutes. On Christmas morning, I had only 529 subscribers on YouTube and 550 followers on Twitter. These numbers are tiny. There were rarely more than a few dozen folks on the stream on any night. The reality was, people didn't care about boring, repetitive analysis of GameStop and other stocks, and that was fine. For those of us who did care, the stream provided us an outlet for refining our fundamentals-based thesis. We were able to analyze events in real time and keep each other honest. Although Keith became a legend after the GameStop short squeeze, he was little known before then. By the end of 2020, he only had about 500 subscribers, so the idea that he could impact GameStop's stock price is absurd. He goes on to say, "Ultimately, my GameStop investment was a success. But the thing is, I felt that way in December far before the peak when the stock was at $20 a share. I was so happy to visit my family in Brockton for the holidays and give them the great news. We were millionaires. That money will go such a long way for my family. We had an incredibly difficult 2020. In addition to dealing with COVID, we lost my sister Sarah unexpectedly in June. It brought me tremendous joy to share the good news with my family for a change. I am grateful to be able to give back to my community and to support my family, most of all my wife Caroline, who has stuck with me through very tough times. As for what happened in January, others will have to explain it. Threshold list, order flow, halting purchases, according to the media, these all had a material impact on GameStop stock in January. Here's the thing, I've had a bit of experience and even I barely understand these matters. It's alarming how little we know about the inner workings of the market, and I am thankful that this committee is examining what happened. I believe an analysis of GameStop's recent price action must start with a discussion of the exorbitant short interest in the stock, as well as an investigation into any potentially manipulative shorting practices and brokers' reported failures to timely deliver shares and settle trades. So he is happy that he made millions of dollars on his investment, which he 100% deserves. He did the due diligence to the stock and put his money where his mouth is by risking a sizable portion of his net worth on GameStop call options. He invested in GameStop based on his fundamental thesis and doesn't have a deep understanding of the intricacies of how the market works, but he's glad that Congress is taking interest in investigating the situation. There are obviously real problems with the financial markets where hedge funds are allowed to short more than 100% of the outstanding shares of a company, and Robinhood can halt trading, which many argue was itself market manipulation. As far as what I expect moving forward, GameStop's stock price may have gotten a bit ahead of itself last month, but I'm as bullish as I've ever been on a potential turnaround. In short, I like the stock. And what's stunning is that as far as I can tell, the market remains oblivious to GameStop's unique opportunity within the gaming industry. These are very interesting times we live in, and hopefully the House Financial Services Committee can give Keith a fair hearing. We will be monitoring the testimony closely, so make sure you hit that subscribe button so you don't miss any updates in the situation. As always, thank you guys so much for watching, and we'll see you in the next video. Wall Street Millennial, signing out.